All right, cool. Awesome. Well, thank you guys for showing up this week. This will be a presentation for the EMBA cohort for Anderson. It will be led by myself and Kiro. So we're from Blockchain UCLA, the student group. Um, it is a cross-campus organization focused on bringing together the community between all campuses to push forward the space of cryptocurrency in general. So the club has existed for about 5 years now. So it's quite a long-standing club on campus. We've done lots of things in the past between event hosting. We've actually worked with Anderson students in the past. We've had actually Tim Draper come and speak. Um, I've also done other things, hosted a full-day crypto conference, as well as doing other activities. We also teach a blockchain class within the engineering school, as well as doing several other blockchain-related programming events. So yeah, this week, we wanted to kind of give a higher level overview of crypto and what it means for the general market as a whole. I'm sure you guys have been aware of how crypto has been affecting the markets, the news. It's been getting a lot of traction throughout 2021 and throughout this year as well. So we'll have some thoughts to start off with on macro, and then we'll kind of go into the rest of the presentation. But yeah, Kira, do you want to introduce yourself and kind of give some background on what you do as well?
Yeah, so I am a junior mechanical engineer, but I've been involved in crypto since the 2017 bubble, and I very passionate about in general the macro, the philosophy, and like the free market nature in general. I'm on the board of the blockchain club as well, and yeah, thanks, Jason.
Yeah, cool, awesome. So yeah, for today's presentation, we have, just to start off with, some thoughts on macro. Since nowadays, being so prolific, cryptocurrency is affected by macro, as well as from that, we have thoughts on just Web3 and crypto as a whole. So how does this paradigm shift actually affect the industry? Why is this thing significant at all? How it's more a revolution than just a marginal improvement on what we have in terms of technology and financial technology. We'll go into some high-level overview of the DeFi markets. DeFi here meaning decentralized finance and how they work. And then we'll end with kind of a case study here on Curve, which is sort of, you could say, a Web3 business. Dive into all the details of how these Web3 business models actually work compared to your traditional brick and mortar Web2 business models. So to start off with, I think it's kind of prescient to talk about macroeconomic policy, especially as it relates to interest rates. Of course, throughout the 2020, the whole 2020, like the coronavirus pandemic, as well as the Fed's response to all this, it's been really a dynamic shift in the way that these capital markets have been priced. One major factor here is just equities, right? Ever since March in 2020, with all the asset purchases, the Federal Reserve has really stepped in and made a big difference in these markets, as well as doing stimulus payments directly to people. The kind of influx of capital into these into the hands of these buyers has really changed the nature of really the psychology of the market. Traditionally, right, like throughout the past 10 years, we've been having a very kind of flush capital market with low cost of capital, very just lots of cheap money being thrown around. And with the events of the coronavirus kind of response, we're kind of starting to see the tail end of it of, how do we recover now that, inflation has been going up to, mid single digits year over year since last year. So the kind of the way I wanted to lead the presentation was to actually have some thoughts on macro as kind of a thesis to bind this all together. This is because crypto, as being a $2.5 trillion asset class now, is actually more correlated with some of these tech equities than previously it was, especially as seeing as the kind of flow of capital has been coming from investors who have also been purchasing traditional assets like tech equities and so forth. So one major point here is that as a response to the election year, we will probably see these rate hikes as forecasted by a lot of opinion, a lot of writers, a lot of people who write, a lot of desks. There's forecasted rate hikes And what that means for crypto is, of course, you generally see these prices fall. The perspective I take long term here, though, or I guess in the medium term, is that the rate hikes won't last forever. The Fed has come out and said that they are planning to reduce the growth of their balance sheet to zero, and they've done so in a kind of a nebulous way, as it is the nature of the Fed to not actually tell exactly what they're doing. A lot of the work they do is through this invisible hand of the market, by not actually saying what they're going to do, but kind of suggesting it. The market actually kind of, does it in preparation of the Fed, and, kind of gives you that, like the tail wags the dog behavior. But with regards to crypto, right, like this would actually give us quite a bit of time before we actually expect another like institutional downturn. Between 2017 to 2020, there was a really fast bull market that came through all this, this rapid influx of capital. But afterwards, there was kind of a lull in terms of token prices, fundraising, and all that. However, this time around, the kind of one of the predominating theses for the space is actually that the bear markets are not going to last as long. In fact, the kind of innovation cycles are becoming shorter as more talent and as more productivity is happening in the space. So you're actually kind of seeing shorter cycles, which will lead to, when you zoom out, a much lower risk of a protracted bear market. And in fact, something that will hopefully will be helped by a more bullish, or I guess more dove-like central bank policy. One other thing is the kind of nature of these markets gives us a lot of, I would say, weird behavior. One thing I wanted to talk about was the idea of these detached revenue multiples. So narrative-based investing is something that we've been seeing happen a lot recently. You guys saw it with GameStop. Some of these other like cryptocurrencies, they're completely detached from the whole idea of what the revenues actually are. You're not getting like, in the kind of more traditional space. If you look at these high revenue area or high multiple areas, you would look at, enterprise SaaS. You could get, 5 to 10x revenue multiples on some later stage companies. In crypto, there's kind of a whole rewriting of the process here. So the base question is, how would you actually value these cryptocurrencies as a result of the cash flow? Do they even have cash flow? How do you actually even approach these valuations? One thing that investors like to use is called the FDV, or fully diluted valuation. Traditionally, what happens in the kind of the cryptocurrency space is that when you do a fundraise, you would set a kind of max supply of the token. So say in this case, for Bitcoin, there's 21 million tokens, although Bitcoin never did a fundraise. It was a much more kind of organic process. If a project were to come out and say, okay, we will have 50 million tokens as a whole, right? And this will be the total supply of tokens that will ever exist. And more often than not, what they will do is they'll set some sort of emission schedule of these tokens, and then and then do fundraises based upon the fully diluted valuation of these tokens, right? One way this kind of differs from equities is that in your traditional equity fundraise, at least for a startup, you would just be diluting 10 to 15% roughly each round. Here in tokens, the idea is that you would actually just determine the kind of the end date and the end supply of the tokens, and then just work back from there. And this is actually a positive thing in terms of behavior for crypto. What this actually does is, by doing the math backwards and figuring out the total supply of the tokens ahead of time, what you're actually doing is you're rewarding the early adopters, which is really necessary for bootstrapping any crypto protocol or any new platform in general. One of the issues that Web 2 or just traditional tech companies have issues with is their cost of customer acquisition, because they have to get users on the platform. They need to offer incentives, discounts. In the case of Uber, they were giving people like a bunch of free passes. They were paying drivers a lot. They would raise a bunch of money and then use this money directly to go, burn the cash and then get new people on board. With Web3, there is a fundamental difference in that there can be token distribution for the early adopters. As a result, you actually don't have to directly be paying your users with cash or with discounts. You can actually be turning your users into stakeholders into the system, by doing some sort of token distribution. This token distribution could vary from airdrops to just simply listing the token and getting, having people purchase the token, to some other methods. So this is actually one thing that is really different from the whole perspective of the ownership of the platform. And as a result, there is not necessarily a focus on the revenue for a lot of these crypto protocols, because their whole method of getting an asset, of getting a stakeholder base is much different. So that's one kind of key differentiator we see in these systems. One other thing is that crypto in general has been used recently as kind of a hedge against fiat monetary systems. So we talked about the idea of these central banks kind of setting policy and kind of controlling the market as they wish, to put it bluntly. There's been a few CEOs who have been looking into Bitcoin as sort of a hedge. And at this point, right, you've probably heard from people, you can keep 1 to 5% of your net worth in crypto. Although if you've been listening to that advice, your portfolio is probably over indexed on crypto now. So you've do with that as you wish. But yeah, it's been safe to say a really good time for cryptocurrency in the past 2 years. There is now sort of institutional legging for this space on the traditional finance side of things. So in Wall Street right now, this stuff is no longer just kind of a fad. It's becoming institutionally adopted. The people who want to use it are hitting up their brokers. They're saying like, hey, we want to start trading. We want to start using these things. So as a kind of financial vehicle or a financial asset, crypto's actually done its job very well. And then one other thing is the idea that that in terms of revenue, a lot of these crypto protocols are actually getting their cash flow supplied by the issuance of new governance tokens and other cryptocurrency protocols. What I mean by that is that because the space promotes a open and permissionless nature of interactability. In other words, you can build a cryptocurrency protocol that builds on top of another cryptocurrency protocol. So you can build, a stable coin that takes Ethereum as collateral. You can, build a voting platform that takes a governance token and, is essentially proxied by your own governance token. The kind of open nature of these financial assets actually lend a lot to utility being able to be recycled. And as a result, you have kind of financial stacks where different platforms will have their token and their whole, their platform itself inserted at different layers along this stack. As a result, what these kind of platforms will actually have is that they'll actually have revenue in the form of getting tokens, right? In the form of lending or other schemes in or other strategies for these kind of token distributions. They will be participants, and as a result, they will actually get cash flow, but in the terms of other cryptocurrency protocols tokens. This again is a result of us being pretty early on in the whole decentralized finance / cryptocurrency space. One thing you really see a lot is kind of an early but very quick pace financial ecosystem evolving. We previously, before this, like DeFi era, were mostly dealing with just layer one blockchains. So you had Bitcoin, you had Ethereum, which brought the idea of smart contracts and computability onto a blockchain. Nowadays, you have these several other layer ones, as they're so called, bringing their functionality onto these blockchains. But the difference here is that when you choose to build a platform on a specific blockchain, you actually get access to all the other platforms and data that are being built on this blockchain. As a result, integration is much easier since it's all permissionless. You don't actually have to get permission or purchase data from other people or other businesses. You can actually just directly start using it because the data is all public and stored on a blockchain. This is one of the biggest differences between Web3 and Web2. It's that it's no longer siloed data lakes. It's really an open ocean of data that is very easy to financialize in the form of tokens. So just some general thoughts on the idea of where we are with valuation, cash flow, and kind of high level topics. And Kiro has this slide on cryptos correlated to equities.
Yeah, so I find that this is a really interesting phenomenon in the market space. So the Pearson correlation coefficient that you see there, 0.871, it suggests a significantly high positive correlation between Bitcoin and I plotted it against the S&P 500. And now, like, what does that mean? What does that mean about market participants? It means that the actions are highly correlated, so that the person in the institution that's buying and selling S&P 500, Nasdaq is that exact same participant in crypto. And in that sense, I guess everything is risk on, and they fall into like the similar basket of goods, and they are valued similarly. Where like Bitcoin and Ethereum and all of these other assets are viewed as far more speculative than I think they 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 give margin to be. So the reason that I find this so interesting is that the philosophy of the assets that are being traded here are not the same in nature. Like the Nasdaq necessarily tracks speculation and market activity and all of these things, whereas Bitcoin was designed to be a risk-off asset by Satoshi in 2008, 2009. So the fact that it wasn't designed to be risk off, and the fact that it is, it was designed to be risk off, and it's now treated in a risk on manner, is interesting. And we recently saw a drawdown from 67,000 all the way down to sub 30K, in fact. And the question that I pose to myself sometimes is like, so you have these participants that follow that correlation immediately. And there was a point on the trading day when I was looking at the chart on the 3-minute mark, on the 3-minute candle, and it was the exact same graph that was happening with Nasdaq, S&P, and Bitcoin. And whether those are bots or whether those are people, the liquidity control there is by the same participant. And I think it poses an interesting question as to when do those people or participants have insufficient liquidity to do that? Or rather, when do they run out of coins to sell? And like a kind of a view of the market in that point, which then leads me to this next point of a possible decoupling. And I think there's a lot of alpha and a lot of edge to think in this manner, in that the philosophy of these assets is not, these are not designed to be this thing, and they're being traded as if they are this thing. But Bitcoin is the same thing as it was in 2009, basically. I mean, it's gone through some minor upgrades in transaction speed and block size and these things, but like it's roughly the same thing. And in 2009, 2012, 2013, I don't know if you guys have all heard of Silk Road, but it was this like drug website on the dark web, and it was basically that was this thing's only use case, right? And it was like the rep that it got for that was really bad. But I mean, today, I mean, MicroStrategy, they hold $2.25 billion worth of Bitcoin on their balance sheet. And that's no meme, that's no joke. This thing is an institutional grade store of value, and there are plenty of listed companies that are using it in this manner. So the question of this correlation is then when is the inflection that people start using the assets as they were designed to, rather than as a free market kind of tool? And I think this this kind of view translates across the crypto industry as well. For example, Ethereum, which is a transactional layer of crypto. When Ethereum starts getting valued in price in terms of its value that it's adding to market participants, in terms of number of transactions, in terms of value moved across the world, I mean, it's a completely different price to what it is now. The amount of people that are using this thing is the exact same as it was 2 months ago, yet the price is 50% off. So I've got to really like ask yourself, like, why am I here? What are these valuations, and who is right and who is wrong? Yeah, so that's my chat on correlation.
And then kind of continuing with the idea of the whole thesis of where we are with macro. For those of you who are invested personally into some of these projects, whether on the private market side or the public market side, the public market side, the guidance is easy because these tokens are liquid. The private market side, specifically startups, angel investing, and so forth. One phenomenon that we've kind of I myself have picked up on is kind of the ways to exit here if you're in these fundraising rounds, right? First, obviously, is just selling off in the next round of secondaries. Some of these crypto fundraisers that have been happening have been quite insane. They are really driven by the fact that we are in a very loose, a very dove-like period of monetary policy, right? Like with all this new money being printed, the flow quickly finds its way to venture capital firms, whose LPs are endowment funds, hedge funds, pension funds, and so forth. One other thing is that the potential for a token actually gives so much speculative power in these fundraising rounds that companies are actually doing really like they're able to actually just raise on equity with the hopes of a token being priced in. One thing that this allows investors to do, obviously, is when the token launches, after the lockups expire, which are usually negotiated. But say you have an equity fundraise, token goes live, and a certain tranche of a certain round of investors all obligated to a 3-month lockup. Well, after that 3-month lockup, these tokens are completely liquid, and they usually get 7-figure trading volume if they have a decent market cap and decent adoption. As a result, you have kind of instant liquidity, which is really something that's extremely new to early stage fundraising, right? You can always do secondaries if you're a founder, and get some de-risk in that sense. But having the other investors who 1 or 2 rounds ago now have a liquid object to then sell directly to retail is actually something that we've it's a kind of a once in a lifetime like opportunity. Of course, there's a lot of sort of pending regulation, pending guidelines from the SEC and so forth. So we'll see how that turns out. But kind of through this past year and a half, one thing we've really seen, and myself as well, is that these token launches are really helping these crypto platforms fundraise extremely quickly, extremely lucratively, and also with a lot less friction than they used to be, right? Because now the question of a business model can be pushed down the road. There can be tokens that are circulating, that are launched, that don't actually have necessarily fully developed business models, that are kind of able to raise funds through these offerings, and then they're able to kind of pivot in the market as they go, instead of being beholden to just a certain class of institutional investors, as they kind of more traditionally have been. One of the point here is that being price agnostic is really a really good strategy in crypto. What usually happens here is that being such a cyclical market, you actually have a lot of fat tail distributions. There's really more often than not, you'll see the case where you can invest into 10 different cryptocurrencies. 9 of them might not do anything in the long run, but one of them might 10,000x or at least 1,000x. For example, the original price of Ethereum or Ether in their ICO was 30 cents. So nowadays that's a 10,000x, something that's quite unheard of in really anything ever. But yeah, like these kind of returns on these tokens are actually extremely kind of biased towards having these insane returns. So the spray and pray method in certain markets actually works quite well in the cryptocurrency context, since you're able to actually have such crazy flywheel effects when it comes to mass adoption on the valuation of these tokens. And Kiro, I think Kiro has a point on these.
Yeah. So like, I mean, these are just examples of what Jason was saying. And I think it kind of reflects to my point earlier on like valuation of these things. So this is the Solana, which is a layer 1. And really the point being here is that this thing is the same asset as it was, as it launched, and it's gone through upgrades and whatever, but the thing is the same. And if you look at this chart now, it's gone from 250 right down to 100. You're down 65% on your money, but it's up 22,000% still since its all-time low from when it launched. And the next one is also even more interesting. So this is Mana, and if I showed you this chart in 2017, so this is the time scale in November 2017 to April 2019, right? And you can see this thing go from 0.27 all the way down to 0.06. So you're down 80% on your money. You invested in the top of the cycle, and you're feeling really bad about yourself. Now, this thing is still the same asset, right? And Jason, the next slide, please. Right? This is what it looks like now. So if you bought it at its all-time high when in 2018, you'll still be 32,000% up in 4 years, right? So when the valuation of these things, it's the expected value, if it goes up and if it works, is just like infinite, because these are genuinely like world-changing technologies. So the kind of valuation approach that you have to these things, it cannot be any traditional model that relies on PE, PS, anything like that. You rarely have to be agnostic about the philosophy of what's going on here. And I think, yeah, I wanted to raise that point.
Yeah. Yeah, and then one other thing to kind of segue into the next topic of the presentation is that, with the result of all this money printing going on, you have this sort of like quasi-centrally managed economy, whereas the contrast here is that, crypto here is really a bridge between these kind of managed financial systems. Crypto itself, being non-centrally managed, it has its trade-offs, right? Usually what goes on is they're governed by a predetermined set of rules instead of responsive decision-making. This is usually what people mean when they mean decentralized, right? There's like a network, the Bitcoin nodes on the network have a certain set of rules they must abide by through the software. So it's actually just written in code and the behavior just runs. So for participants in the Bitcoin network, they just, they implicitly comply by just running the software and mining Bitcoin. And the kind of software and the protocols is kind of has its rules encoded into it. Whereas, here in the US, we have the FOMC, which they meet every 2 months, decide on the interest rates. Of course, there's benefits to each of them. I don't believe a future of only decentralized monetary policy would be good for anybody. Although having the situation where you have kind of the benefit of both actually works quite well, since essentially, the sort of centrally managed economies being able to respond to recession-like events like the COVID-19 pandemic give society a lot of flexibility in terms of how it can help people with the government in power. And the existence of crypto gives people an alternative to their store of wealth and the transfer of value outside of the traditional rails of finance, right? So instead of doing a regular wire, you can just be sending your Bitcoin across between borders without having to do any filings or any complicated financial statements, at least for now, and hopefully it will remain that way. As crypto kind of gives us this technological innovation that allows us to actually do things that were only kind of permissioned before. Yeah, and then I will switch the presentation up here. I actually don't know. I was at one more. I actually had a few more slides. Akira, I think you're muted, by the way.
Yeah. Is that fine? Okay, cool. All right. So, can you hear me fine?
Yeah.
Okay, sweet. So just a global perspective on like the markets and stuff, because I think everything. So I'm from South Africa, so I have a different perspective to these things. But the equality of markets is interesting here in that it's the most free that I've ever felt that a market has been. So the 24/7 365 concept first is a big one in that there are no sessions. It's open on Christmas. It's open on Easter. I mean, this thing, it never stops. So there is no segregation of the people in that sense. It's just happening. An interesting effect that I see on this is so it's weekend liquidity. So you see a lot of these big moves happen on the weekends. Thin books, big price swings. How long that lasts, I don't know. And if it is going to be an institutional grade kind of thing, does that still need to apply? Another trend is Eastern selling and Western buying, which basically means there's like this meme in crypto where whenever China wakes up, the thing goes down, which is pretty funny. And then yeah, there's that trend. And then more than just markets, I think it's important to remember that these things are solving transactional problems and actual problems in a lot of countries. So I have a graphic there that shows you, so there's like, I don't know, 4,000 people per country that responded here. So I mean, take it with a grain of salt. But 32% of those people that responded in Nigeria and Vietnam, Philippines, whatever, these people are using crypto. So I was speaking to my barber back home. He's from Nigeria, and he was telling me that on the side of the street, they don't buy like sodas and crisps and stuff with the Naira. They buy it with Bitcoin, with wallets, and then the transaction happens inside the exchange, so it's quick and it's free. So it's not significant in that. But the point being here is that all of these countries here have hyperinflationary currencies, and the correlation is that it's high with Bitcoin usage, and it is growing. And then also a fun thing is the IMF publishing a report saying how the crypto ecosystem is going to lead to financial instability of the world. And I think that it's interesting commentary on where we are in the grander scheme of things.
Cool. Yeah, and then I wanted to make some points on just this idea of money itself, right? So the three core use cases are the store of value, medium of exchange, the unit of account. This in a similar way with how 90% of the money in the US is digital, right? Just reported between bank ledgers for interbank lending. A lot of the money that you see, in cryptocurrency it's completely digital. But it's actually one interesting topic, right? Where day to day, right, we're at the point of innovation where in cryptocurrency you usually can't go to a store and buy crypto and buy goods and services with it just yet. This is a result of high transaction fees for the platform, making retail adoption somewhat infeasible, at least for now. The core reason behind this is that the ethos of decentralization, making all the data public and available, and also allowing anyone to run a node for the cryptocurrency itself, or for the cryptocurrency L1 layer itself, creates some restrictions on the computational power of these networks. As a result, the users have to pay quite high transaction fees at times in order to actually use the networks, thus making it a bit early in terms of widespread adoption. However, one thing that technology has always been good at is making things faster and cheaper. So you can kind of think of this as the era of mobile, where you have 2G, maybe 3G networks. And then, soon enough, we'll have 4G LTE, and 5G networks in terms of the cost and the transaction speed of these cryptocurrency networks. It really comes down to the technology behind these things, how compressed you can make these transactions with cryptography, while actually being provable that these transactions actually occurred on the blockchain. So it really comes down to a computer science problem with some of these issues. But right now, with where we're at, we're actually seeing a lot of cryptocurrency being used as this kind of store of wealth primarily. The store of wealth here narrative is actually quite strong in the sense that for investors who are just looking to park their wealth in some of these assets, it's a really good way to basically be shielded from the traditional financial ecosystem, as you saw with the slide of like Ray Dalio, these Michael Saylor, some of these other big corporates taking kind of a hedge position. They don't need to access the capital right away. They're doing so in order to see what happens with these kind of central bank economies compared to these network-based economies. or computer network-based economies. You have the next slide. Thanks. All right, and then one of the kind of the next topic we want to cover with the presentation is the idea of these DeFi markets actually work on a functional basis. So in a traditional exchange, you have these CLLBs, these central limit order book models, where the users will place limit orders, buy or sell X amount at Y price. And most traditional exchanges would use this model. There's also centralized crypto exchanges that also use this model. So anyone can make a market order and take the best price available, and someone can also create a limit order offering these prices, right? And this is kind of it's been predominant for the past few decades, being the primary method of exchange. It's not too intense. It makes sense. There's a market clearing price. There exists a market price as a result of the aggregation of all these limit orders. And as a result, there's sort of the illusion of a current market price with the aggregation of all the orders. And then the next slide, yeah. In contrast, in decentralized exchanges, there actually is a few fundamental factors that you have to deal with. One here is that these exchanges want to minimize trust assumptions, right? With brokerages in the US or even in the world, you have a broker that previously you would just call up and you would just tell them to execute your orders. Someone you probably would know or at least talk to on a frequent basis. Recently, it's been more of switching to online brokerages, but still, the online brokerages, they have a corporation. They are part of the traditional the financial and legal system. If something were to happen, some accounts, or at least some your bank accounts would be FDIC insured. Your brokerage accounts might not be, but there is enough kind of at stake here for these institutions not to just run up with the capital. At least, fortunately, in the U.S., pretty safe environment here. But in the kind of cryptocurrency area, you don't have the same assumptions, since the blockchain operates through pseudonyms, right? With addresses. So the functional difference here is that you don't necessarily even know or even can know the person you're dealing with. All you're given is lists of addresses that are making transactions on the blockchain. But this actually doesn't prevent anyone from transacting. And the reason for this is the idea of computability on the blockchain. So this is something that's been pioneered by Ethereum, but the fact that you can actually have smart contracts, you can build in business logic into these smart contracts that allow for the execution of exchange-like behavior. As a result, right, the code is actually the one that's running. It's not given off to an agent to actually execute your order. Through this, you're actually able to minimize trust assumptions and completely remove the middleman in these sort of economies, and you're actually able to have the code sort of be the law here, right? So that one of the kind of mantras of blockchains is that the code is law. Whatever is executed by these nodes running the software is the actual, the state of the world. So in terms of these financial assets, if you're making trades through smart contracts, all that happens is your orders are submitted and they're executed on chain. And there's no other middlemen, since the miners are essentially the ones processing your transactions, but there's no other agent involved in the actual placing and creating of the orders. One other thing, though, here in kind of cryptocurrency and decentralized finance is that you have the Oracle problem. So pricing the assets here also requires trust. If you don't have a developed market yet, you actually can't. You need a kind of an exogenous price. The reason that you have a price that exists in central limit order book exchanges is because there's enough orders that exist to give you the price, right? So the current price is just somewhere between the lowest sell order and the highest buy order. Whereas in cryptocurrency, a lot of the problems that people trying to create synthetics run into, or these other financial products, is that they don't actually have a reliable, trustless price oracle, right? If you're trying to create a lending market on a blockchain, the assets already all exist there, right? If you're trying to create, if you're using a lending market on Ethereum, you have all these tokens that exist that have, they have a value that you're able to, trade and swap and buy against. But the issue is that if it comes to lending, you need someone to, do the marks and actually figure out what the prices of the collateral are if you were to make a loan. But the benefit of this is that over the past 2 years, the kind of flourishing of these decentralized exchange markets has actually allowed the creation, or the emergence of an endogenous price vertical. So in the next slide, we'll talk about Uniswap and how actually Uniswap creates this, actually creates a market clearing, or creates a current market price. So what Uniswap does is actually, it's an automated market maker. What it does, it matches the sellers and buyers in a predetermined fashion. The way it does this is that it introduces the notion of a liquidity provider, who is basically someone who deposits both assets in an asset trading pair, right? So you have token X and token Y, right? What will happen is the liquidity provider deposits both token X and token Y into the trading pair, and people who trade against it will change the ratio of the reserves that currently exist into the pair. And so the way it works here is that they use something called the constant product rule. And so the constant product rule is formerly also known as X, Y equals K. So the amount of reserves X times the amount of reserves Y is always equal to a constant K in between trades. So what happens is if a trade is ever executed on a pair of assets on Uniswap, one of the numbers will go up, it's in this case X, right? But then as a result, the other number Y would go down in proportion to keep the value K the same in between trades. And the idea here is that you're giving, you're kind of rewriting the roles of market making. It's no longer just people who can buy and sell. People can also provide liquidity, and by providing liquidity, what they do is they actually earn trading fees from the protocol, right? So what happens here is that the Uniswap actually has the trading fee of 0.3%, so 30 basis points, and the trading fees actually all go to liquidity providers. Normally, if this would be normally this trading fee would be absorbed by middlemen in the brokerage kind of environment, but in this case, since these assets are all on chain, deployed through smart contracts in a permissionless setting where the code is all open and visible, you're actually able to have an environment where the middlemen have been basically completely cut out, and the people who are earning the profits here are directly the people who have the capital. So it's really one thing about it, kind of a testament to the resilience, but also the expressivity of these decentralized finance platforms, is that they're actually able to allow a whole set of stakeholders to kind of move in to an area where they weren't able to before because of rent-seeking behavior.
So I'm actually gonna do the I'm gonna go over how we value. So this application, Curve.finance, is one of these Web3 companies, DeFi protocols, and it works in a similar fashion to what Jason just said, in that it is an automated market maker. Its USP is low slippage. That's what it wants, low slippage, and it's usually used to swap stablecoins. So here we have a thing of DAI and USDC, which are two tokens that track the price of USDC. And obviously, when you're swapping between dollars, you don't want for there to be any difference in the prices of things. It needs to be one-to-one. And this is what Curve does. They have tons of volume. They have a different approach to the X, Y equals K, in that it's not as sensitive to price fluctuations in that way. Just an overview of the DEX market before we go into valuing Curve itself. So the volume on DEX as well is over $1 trillion last year. And Curve has roughly an 8% share in that, which is a lot, obviously. And it has 20 billion in liquidity. So what Jason was just speaking about in the LP pairs, Curve has 20 billion of that locked up there across their various chains. And this here is a graph of that, which is fairly, up and to the right. Now Curve, the way that they operate as a business, I guess, is this thing called CRV tokens, which are governance tokens. Jason briefly mentioned this before, but these are tokens that are used to basically participate in the how Curve runs. And you can get these through two ways. You can buy them in the free market, or you can provide liquidity to an LP pair, and then you get them as rewards, which is then part of their like emission strategy. And this token, this governance token, has some use cases. And for Curve, it's voting, staking, and boosting rewards. So voting means that you can participate in how Curve runs. So people can post proposals to this DAO, and then you can vote on the proposal, and you can choose like, you know, the where you want the protocol to go, and like affect gauge weights and all of these very technical things. And your vote is proportional to the amount of Curve that you hold. And in Curve, this is actually a very important concept, but I think it's a bit too much for now. The second is staking. So when you stake your Curve, you basically give your Curve to Curve, and you lock it up. And you then get 50% of all the trading fees that these guys generate. And then lastly, you can boost your reward. So in the LP thing that you just did, so when you provide liquidity, you get a certain amount of Curve tokens. But when you choose to boost your rewards, you can multiply them by up to 2.5 times. An interesting a thing that's specific to Curve is that you need to lock up your Curve to do this, and the longer that you lock it up for, the more power that you have in all of these various things. So this is the Curve token. This is the governance token, and yeah, so we can move forward to trying to value this company based on this token. So this analysis has not been done by me, but rather by an article in Masari, and there's a link in the slides to it. And if you are interested, you should check it out more. But this is a discounted cash flow analysis on Curve Finance. The parameters that these guys used were 100% year-on-year growth rate, which is actually conservative in that it's much lower than what has happened before. Just in context, the Binance, one of these centralized exchanges, has a total volume of 7.7 trillion over last year. Total DEXs all combined was only 1 trillion last year. So they have a lot more to go. Also in this discounted cash flow analysis, we're only looking at trading fees, not any of the staking rewards, not any of the boosting rewards, just trading fees. And we're using the total amount of Curve tokens in supply. They have a 9% market share. We're using a 15x terminal value and a discount rate of 20%. And this gives us a price per Curve of $0.86. The current price is 3.6. So the only model of this discounted cash flow thing that I've seen work is an extreme growth model where they predicted 350% year-on-year growth rate. Well, 350% next year, scaling down to 3% in 2026, in which it met fair value as it is now. So that's the discounted cash flow. And in all scenarios, basically, this thing is overvalued at present. Next, we have Curve compared to its peers. So we have similar AMM markets, Uniswap, Sushi, Balancer. They basically, they do the same thing, the same function in different ways. But here we can see Curve is not looking good again. So we have a price to sales multiple, and it's it's not good at 76.6 times sales, and also dividend yield at 0.7%. I don't really want to go into all of this stuff, but in the article that is in the slides, you guys can dive into it deeper, right? So that's a comparative valuation. This is comparable valuation. And anyway, I'm just running away with the point that these guys are trading at a premium compared to their peers. And does this make sense? Do these models hold? Does it make sense to value Curve in a typical business model kind of fashion? So currently, like, the actionable intelligence that you kind of gain from this thing is not much, in that you can only compare it to their peers, and they're all trading at like 70x multiples to sales. So it's like, I mean, what are you going to do with that? And my point here, more than that, you can model these things like this in DCF and PS and PE and all of these things. You can do it, but it does not make any sense because the fundamental business model that we have here has changed. So in this person's analysis of these discounted cash flows and stuff, the main issue here is that curves and their tokenomics, as we call it, so like the distribution of tokens everywhere, that is basically one of their USPs, in that like 42% of the entire supply is locked at present to gain these voting privileges and these staking privileges and these boosting privileges. So like it doesn't account for that. And obviously that lock supply changes over time with like various lockups. And we have a scenario where like these cash flow models and stuff like that, they do not work anymore. So we can try to do that, but the point that I'm making is that it's different, which leads me to wrap up quite nicely with what I was going to say before, in that the key stakeholders that we have in Web3 in business have changed, in that the way that cryptocurrency works and the power that it gives to individual users is fundamentally different to traditional business models. So the customer, the shareholder, and the employee, those definitions of traditional stakeholders begin to merge into one. So for example, if I'm a Curve user and I'm using Curve and I'm using it to transact, but I'm also using it to earn yield on my dollars, right? I'm both a customer, a shareholder, and I can vote on where this business goes, right? So the traditional way in which we've defined a user is now changing. And this is something that we need to adapt to, which like DAOs is obviously something like that, where we can vote on proposals and the customer can choose how this business goes. And I think more than anything, what the system does is that it allows value to accrue back to the user that is giving the protocol value. So this last point is a little bit vague in that if people can operate in a system where they receive the value that they make, why would they not do that? And this is the point in this slide. And this is a Web3 like very high philosophy back view to view this thing. So basically with Web 1, we had read-only content in that we had things that were posted to the internet, and then you can view things that are posted and shared, and people can view this content. With Web 2, people are allowed to write. So we have this whole trend of the creator economy and people posting things to YouTube and Instagram, and people are sharing their thoughts on Twitter and stuff. So we now have people that are producing this content. And in this, we have the tech companies that host this content and allow people to view it, right? And what ends up happening is that even though people are making the content, the whole monetization process happens inside the tech company. So if we take Instagram, for example, the whole thing is reliant on people producing and viewing content. People must do that, right? But that whole value process, that network effect, that value accrues back to tech companies. It does not accrue back to the user. And I was talking to some of my friends today about this, and the value in Instagram is not that it has a good protocol, because I think early on in Web 2, you see that, where Facebook is like very valuable in that its protocol is truly revolutionary. But we're now in a stage where it's like, I can find a copy of Instagram like easily, and there are like a million variations of this thing. So it's not the protocol that's giving it value, but rather it's where people are. I post on Instagram because it's where other people want to be. I'm on Instagram because it's where my content wants to be, right? And that is the value of Instagram. So we've completely placed the value of this social network outside of its protocol value. Its value is in its network users. And the thing here is that value accrual in Web 2 is not fair, in that it's just been people are being cut out. And at a very philosophical level, Web 3 changes this, and it allows value to be that is created by the people to accrue back to the people. And just to finish off, the Web 3 definition that I've had is interesting in that, like, this whole concept is a couple months old, and people can't even agree inside crypto Twitter, like whether like Bitcoin is Web 3, is Bitcoin Web 3, and depending on who you ask, there's like 30,000 votes in between these two polls, and it's both yes and no. So it's new, but my point being is that it's yet to be taken, and traditional business is going to have to innovate and find a way into this new area of market where these incentives for people exist. And that is all I have to say.
So yeah, thank you guys again for coming out, for watching the recording. Feel free to also just contact us on Twitter. We're also running a Discord for the club. So the club is primarily composed of undergraduate engineering students as well as undergraduate non-engineering students. We have presences in both the law and business school campuses where we try to host events. So sort of these things, these are initiatives that we're looking forward to. So if you guys have any questions, any contacts, any concerns, if you'd like to, speak on ideas, feel free to either, hit us up or just drop by the Discord. All right, cool.